Hello and welcome to Cafe Mutual YouTube channel. Friends, despite volatility and uncertain global environment, markets have not seen any significant correction over the past few years. This is a very rare event. Because of this, many distributors are confused on the future course of the markets. To give us clarity on trends and development in the equity markets, today we have invited Chirag Mehta, CIO, Quantum Mutual Fund. With over 2 decades of experience in equity markets, Chirag has played a pivotal role in shaping their investment strategy. So, welcome to the show, Chirag.
Thank you, Nishant. Thank you for having me here.
Okay. So, Chirag, I wanted to know that you are a veteran in the industry. So, what are some of the biggest lessons that you have learned over the years, both as an investor and as a fund manager?
Uh, so biggest lesson has been, think long term and give it a time to work the way you thought it will work,
Mm,
right? So have some patience with your investing.
mm,
Of course,
mm,
you have to validate your thesis on a continuous basis is
mm,
what keeps us on our toes. But that is very, very critical in terms of minimizing the risk. So
mm,
how we can manage the risk at the same time look at the opportunities is what makes a good investing overall. So I
mm,
think long term patience and let it compound for you. Yeah, I think that's a key. And also biggest of all is the asset allocation. Asset allocation is paramount,
mm,
and all our distributor friends would be very aware and would be practicing in detail. I
mm.
think if you stay the path of your asset allocation, I think it leads to better outcomes.
Great, 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 Chirag. Thanks for sharing your. Chirag, my next question is about the Indian markets. So, you know
Mhm.
that Indian markets are currently facing several headwinds. FIIs
Yes.
have been pulling out, US interest rates remain elevated, and geopolitical tensions are prompting global investors to look towards the developed market. So, why do you
Mhm.
think this is happening? And what is your outlook for Indian equity markets from here?
Yeah, so we were facing some headwinds in terms of the oil price because of external events like the war happening,
Hmm,
which is one of like oil is a joker in the pack, right? If it goes up, it kind of derails our economy
hmm,
significantly, and
hmm,
hence it does impact in terms of where our markets would be headed.
hmm,
Uh, so so that's one variable. It's cooled off now to an extent
hmm,
from where we were. So I think to that extent the headwind is lower.
hmm,
FIIs are not coming in because there is one theme that everyone's chasing today is AI to an
hmm,
extent, and today it's the world where AI ecosystem has been built out.
hmm,
It's not implemented as yet. When there is implementation likely to happen, when there's integration likely to happen, this is
hmm,
where India can come into the picture. And because we don't have other capabilities at this point in time, we are not part of that story, and
hmm,
most of the money was chasing that as compared to the non-AI that we are, or integration AI that we are. So I think from that standpoint, I think our economy,
hmm,
apart from that oil headwind, is doing well,
hmm,
right? If you look at credit growth, for example, or if you look at IIP example, for
hmm.
example, it's been faring well.
Hmm.
So I think if oil prices were to subside and remain, say, at 60, $70, we are fine as an economy, and markets will start taking that into stride.
Hmm.
Like as we see earnings growth pick up across on a broader scale, we will see that return of FIIs also coming in. So FIS will come when there is earnings to support, when world is not chasing the AI despite the risk that could be there in AI. So I think we as an economy would do well, and once we start delivering onto that earnings growth expectations, we will see that markets take that into positive stride, and investors will come by. So I think we are not too worried, except for the oil, because oil is one determinant which can have shave off a large portion of returns.
Hmm.
It can dilute your potential returns by 30% if we are closer to 110, $120 per barrel. So that's the sensitivity that we have to oil prices. So
Hmm.
if that is controlled, I think we should be good to go from here on.
Okay. So you are not seeing any significant correction going forward if oil, of course, remains stable. I mean, stable.
Yeah, if oil remains stable or well within that 60 $70 or maybe even $80 barrel, we should be okay. We should have that slow recovery go through, and it will gather pace as there is broad momentum comes in. So I
Mm,
think if we are within that up to say between 60 to $80 per barrel, we should be fine. But anything above that
mm.
should start shaving off some returns from our markets.
Got it, got it. So Chirag, flexi cap has become almost default categories for new fund houses, with several AMCs, new AMCs entering the market through this route only. So given the intense competition and crowded strategy, why does Quantum believe there is adequate room for another flexi cap fund in the market?
Sure. Nishant, as you know us, right? We are not a fund house that keeps launching NFOs,
Hmm.
right? Just have 14 products in 20 years of our existence,
Right.
right? We launch funds when we think we can deliver something exceptional,
Mm,
add value to investors
mm,
from a particular way of investing,
mm,
and we have the capability to deliver to that return expectation that investors will have,
mm,
or risk adjusted return expectations. So
mm,
I think this is the time where we worked on a strategy and saw where it will fit well, and
mm,
FlexiCap was the answer to it, and that is why we are launching a FlexiCap fund. But the concept or the strategy is very, very unique, very, very novel.
mm,
Different way of looking at industry, different way of looking at stocks. Generally, we see horizontally any company or any sector,
mm,
right? Either we look at top down or you look at bottom up,
mm,
right? This is looking at horizontally in terms of the industry profit pool. And there are different participants in that profit pool. So, if, say, for example, in an industry, the 100 rupees is a profit pool, it
mm,
gets distributed amongst various intermediaries, be it suppliers, be it manufacturers, be it the brand, be it the distributors, right? It
mm,
gets distributed within that network.
mm,
But the distribution does not remain constant. It keeps changing. Rather, at sometimes suppliers are in command; they get the lion's share of profits. Sometimes the brands are in command and they get the lion's share of profit. And sometimes distributors are the ones who are making the much of profit pool. But eventually, at some point in time, there are shifts that happen within that profit pool, and when you capture any industry, any company at the inflection point of that shift in profit pool, that
mm,
is the time you can make a disproportionate risk reward with your investments. And
mm.
that is what we are trying to do. So there are many, many examples. I would like to take you through a couple of examples by sharing some slides
Sure, sure.
so that it becomes abundantly clear in terms of what we are trying to do. If you look at a profit pool of any industry, the industry value chain, as we call it, there are suppliers, there are manufacturers, there are brands, distributors. So there are various participants within the industry chain,
Mm,
and each one has their own share of profits within that, right? Some may have a larger share, some may have a smaller share.
mm,
But over time, this share does not remain constant, it keeps shifting. I'd like to give you some examples. For example, in the healthcare industry,
mm,
so there are suppliers of pharma raw materials, APIs, etc. There are pharmaceutical companies, there are hospitals, there are diagnostics, and there is insurance companies,
mm.
right? So if you see post-COVID, the bulk of the profit went to hospitals and diagnostic companies,
Right.
right? Uh, Earlier, if you see 15 years back, it
Mm,
was only pharma companies within that took bulk of the profit share, right?
mm,
Then it shifted to hospitals and diagnostics.
mm,
And now we see it shifting to insurance companies.
mm,
Because what happened was over time, hospitals
mm,
earned disproportionately in terms of profits, right? Over time, so last 1 year, if you see, medical inflation is kind of slightly plateaued.
mm,
Whereas if you look at, insurance companies, they were bleeding for last 3, 4 years when hospitals were enjoying disproportionate profits. Over time, insurance companies passed on this cost to consumers. If you look at medical insurance premiums, they went through the roof, right? 3, 4 years, we saw significant increases in insurance premiums. And now, they have got their cost lower in terms of cost efficient. And at the same time, they are ensuring that they don't get through in terms of higher hospital billings, because they are very, very strict in terms of what kind of bills that they pass through. So over time, what has happened is the shift has happened from hospitals to insurance over last 6 months, and I think it will still play out over next 1 or 2 years. So when we launched a small cap fund, we had two hospital stocks in our portfolio. We exited those hospital stocks, went to an insurance company citing this shift in profit pool. So when hospitals were enjoying, we were in that curve. And now when insurance shift is happening, we got into that curve, benefiting from the move that we saw in insurance stocks. So similarly in automobiles, if you look at the lower half of the screen, earlier what was happening is the brands were earning disproportionate profit because they were squeezing in or suppliers in auto ancillary companies because they were the only customers that they had. Over time, more manufacturers have come into India, like the Korean companies who have come into India and started manufacturing in India. Then you had export markets open up because foreign manufacturers were looking for China plus one, and hence auto ancillaries had more customers in India and the export market, and they said that, okay, I have a lot of opportunities. I will not work below X margin.
Mm.
And therefore, the shift happened from brands to auto ancillaries or suppliers.
Mm.
And therefore, we captured that shift last year in a small cap fund. In March, when we saw this opportunity, when the shift was happening, there was some proof of that shift happening, and the auto ancillary companies were available at significant discount. So we kind of added a few stocks in auto ancillaries in our portfolio to benefit out of that. We have seen that, preference change from non-SUV brands to SUV brands. We played that as well,
Mm.
right? Premiumization as we know it, right? Cult to commute is
Mm.
what we played into our value fund portfolios. So, these profit pools, if you identify them right, there is disproportionate risk reward that you can make by entering it at the right time. So this is the concept that we said we want to play, and these are the four reasons why these profit pools shift. Either it's disruption, consolidation, consumer preferences change over time, or regulatory changes or government policies change that drive those shift in profit pools. And if you look at it horizontally as an industry, you will be able to capture it right as opposed to seeing it top down or bottom
Mm.
up.
Mm.
And that is what the actual concept is. And why flexicap is because the shifts can happen
Mm.
into any segment. For example, healthcare that you spoke about. If I want to play, say, example, suppliers, right? I have mostly small cap companies to play in. I don't have large cap companies there. If I want to play hospitals, I have a mixed bag. I have large cap, mid cap, and small cap.
Mm.
If I want to play insurance, I only have a small cap company. So
Mm.
we don't know where the profit pool is going to shift. But if we are flexible enough or unconstrained in our approach, we will be able to capture it well. And FlexiCap just allows us to do that,
Mm.
right? And hence the FlexiCap fund. So the strategy was novel. It
Mm.
was unique. It helped, capture a risk reward in a better way. And FlexiCap allows us to play it well. And therefore, we are launching the Quantum FlexiCap fund.
Great, great, Chirag. All the best on your launch, first of all.
Sure.
Chirag, my next question is about the FlexiCap strategy only. So, FlexiCap funds, multi-cap funds, and ELSS all
Yeah.
provide investors exposure across market capitalization. From an
Mhm.
investor's perspective, what additional benefit does a FlexiCap fund offer compared with these other two categories?
So, ELSS and focus funds that you spoke about, right?
Focused and multi-cap as well, 25.
Right. Right. So multi-cap, like for example, if I see most industries, if the opportunity is in small cap, I still have to be in large cap and mid caps to the extent of 35%, right?
Mm.
So that's still not unconstrained. That still constrains me to be in a particular place where I still not like or don't see opportunities,
Mm.
right? So even in, for example, focused, I have a constraint of 30 stocks, right? Whereas if you see ELSS is only for a particular set of investors who want to have that tax saving. And in the new regime, you don't have that utility so much.
Mm.
So Flexi cap is something that's unconstrained for investors, is unconstrained for the fund manager, and therefore it is better suited as compared to the multi caps and focused as a strategy. So I think that is where we picked up in terms of the flexi cap category as opposed to any other category that allows us to play in a very unconstrained way as compared to other strategies or other categories that we have.
Okay. So, Chirag, currently a majority of flexi cap funds tend to have significant large cap bias. So, what will be the Quantum's investment philosophy and approach to allocating across large, mid, and small cap stocks?
So the strategy is simple, Nishant, that if there is an opportunity of profit pool in small caps, it will be in small caps. So wherever the shifts happen in an industry in terms of profit pool, we will be into that. There is no decisiveness on or there is a pre-decided allocation to large cap, mid cap, small cap. It just depends on where the profit pool shifts are happening. We will try to capture that as much as we can, and that can be in large cap, mid cap, small cap. So in terms of flexi cap, it's probably going to be true to flexi cap as a mandate as opposed to being constrained or being large cap bias as you're saying it because profit pool shifts can occur anywhere. It could be a broad mix of large, mid, and small. It could be tilted or skewed at times towards small, or mid or large. It could be anywhere. So it will be truly flexible to move where the profit pool shifts are happening.
Okay. So, Chirag, one last question. If you had to give MFDs one reason to choose this fund over an established flexi cap fund with a much longer track record, what
Mhm.
would be that reason be?
So one is to say that the theory is great, right? Profit pool shifts, everyone agrees to it,
Mhm.
and if you capture it right, you can make dual levers of return because there will be earnings growth associated with the shift in profit pool, and at the same time, when market recognizes shift in earnings growth, they tend to give a better valuation to those kind of companies. So there is a double lever of reward that you get, and risk is generally minimal only when your thesis goes wrong in terms of identifying that shift in profit pool. That's the risk that you are getting into, right? So there is the from a risk reward standpoint, it's great. uh, so from an MFD perspective, uh, if you are looking at a novel strategy for your clients, this is the way to look at it. People have so far been looking at vertically, top down and bottom up. No one's looking at an industry horizontally and seeing where the profit pool shifts are happening. I think that is a better way to play out in terms of FlexiCap strategy and allows us to use the FlexiCap mandate to its optimal advantage, and therefore the Quantum Flexi Cap Fund makes all the merit. So if you're looking for a differentiated strategy, something that adds a lot of value from a flexi cap standpoint, utilizes that mandate to an optimal level, then this is the fund that you should recommend to your clients.
All right, Chirag, thank you so much for your valuable time and inputs on FlexiCap funds and all the best on Quantum FlexiCap Fund. Finally, I thank each one of you for being such a wonderful audience. Have a lovely day at work, guys. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.